Economy and Politics show on this wonderful Friday, July 17, 2020, the last active day for the week, as the political economic watch and conversation continues in Nigeria. Let us give you a lineup of what we will be looking at today. The just released Nigeria's June 2020 inflation rate report, Nova's economic outlook for second half of the year 2020, World Bank's analysis on global economic trends and drivers, World Bank increasing financing to $74 billion amidst the global pandemic, FBN Quest's latest analysis on Nigeria's oil and gas sector, excerpts from the remarks of President Muhammadu Buhari at the launch of PAGMI, Federal Executive Council's approval of the MTEF for 2021 to 2023, an IMF forecast of 36.5% debt to GDP ratio for Nigeria in 2020. Let us begin with the latest news we have coming from the National Bureau of Statistics published on ProShare. The Consumer Price Index, which measures inflation, increased by 12.56% year-on-year in June 2020. This is 0.16 percent points higher than the rate recorded in May 2020, which was 12.40%. Increases were recorded in all the divisions that yielded the headline index. On month-on-month basis, the headline index increased by 1.21% in June 2020. This is
first quarter.
With strict rules on social distancing over the rest of the year, the return to full-fledged economic activities might remain slow, as complete containment without major escalation of COVID-19 could extend until the end of third quarter 2020. For balance of payments over 2020, the depressed global crude oil prices amidst pressured demand pose major risk given the expected lower return on investment and feed-through of the global shock on the individual income. Nova models lower income deficit and workers' remittances respectively. Overall, Nova forecasts current account deficit of $16.6 billion on the base case. On the financial account, with the current risk of across emerging markets amidst depressed yields in the local short-term debt securities, Nova expects further exodus of foreign portfolio investors with a negative financing of $3.4 billion and overall balance of negative $19.9 billion compared to 2019 overall negative balance of $5.5 billion. Looking at the currency and foreign exchange flows, Nova believes there is a strong risk of further hemorrhaging in the gross external reserves over second half of the year 2020. Assuming resumption of Central Bank of Nigeria intervention sales at the import and export window starting August with 25% repatriation of backlog and maturing offshore holdings between August and December, even with lower imports and services demands, the gross reserve could close the year at $31.8 billion on the best case scenario. Nova's base scenario assumes that if 50% of the backlog and maturing offshore holdings are repatriated between August and December, the gross external reserves could end the year at $29 billion. With limited inflows and reduced avenues to control outflows, recent unification of rates will have limited impact on the reserves. Nova believes an outright floating of the exchange rate with intermittent interventions to avoid unnecessary speculative attacks will have more meaningful impact. Based on the purchasing power parity model, the fundamental value of Naira lies between $427 Naira to a dollar and 430 Naira to a dollar. That's a minus 11% overvaluation from the current NAFEX rate of 387 Naira to a dollar and an undervaluation from current parallel market rate of 447 Naira to a dollar. For consumer prices, the pressure on consumer prices over second half of the year will largely reflect the impact of the breakup in supply chains and volatility occasioned by the oscillating PMS price. While the impact of the border closure is expected to largely fade off in August, recent events have overtaken its impact. The combined effect of Naira depreciation and expected volatility occasioned by the market-reflective PMS price will further add to the pressure on the core index over the rest of the year. Adjusting the Nova model for the above-mentioned pressures, the research team arrived at a base average inflation rate of 12.3% in 2020, compared to the average of 11.41% in 2019. Looking at monetary policy, beyond doubt, the loan-to-deposit ratio policy has proven to be more potent in driving real sector lending and at the same time moderating the cost of borrowing due to the increased competition for corporate names. However, the distribution of loans continue to favor largely the prime sectors and lenders with limited transmissions to the CBN's preferred sectors. Going by feedback across the banking system, banks are concerned about liquidity and credit risk given current conditions. Due to the import on usual debits have had on system liquidity and overall interbank rates, Nova believes a gradual reform of excess cash reserve ratio will have a more positive impact on rates in the interim. But actual lending to the deposit money banks will require a fundamental change in the economic environment. Over the second half of the year, Nova expects the CBN to focus on reflating the banking system and to adopt more efficient measures around the LDR to further support credit creation, especially to consumption-stimulating sectors. However, Nova sees possible transmission of any further cut of the MPR to CBN development programs and intervention initiatives. In the area of fiscal policy, overlaying lower oil revenue from lower oil prices and compliance to OPEC cuts, Nova estimates total 2020 FGN revenue of 3.2 trillion naira, which is minus 22% year-on-year. Nova believes the implementation of the 2020 budget is largely doubtful, with the scapegoat being the capital expenditure. With the base scenario created by Nova, the assuming budget implementation of 80%, that's in 5 minus our year average, it's 4.4%. It estimates a budget deficit could range between 4.5 trillion naira and 5.5 trillion naira in 2020. While the International Monetary Fund loan of $3.4 billion and the $150 million drawdown from the National Sovereign Investment Authority will unlock about 1.4 trillion naira for the Federation, the 2020 budget will still have a financing gap of 3.2 trillion naira. To fund the gap, Nova prefers scenario assumes the federal government secures the remaining external funding of $2.1 billion and no proceeds from privatization. It models half of the excess amount of 2.4 trillion naira, partly by the Central Bank of Nigeria and domestic borrowings. In the fixed income and strategy, it says, with the paucity of dollars for repatriation and limited avenue to attract foreign portfolio investor funds, the Apex Bank might not be aggressive in raising OMO rates from current levels and could be more inclined to lower it further. On the part of the federal government, to meet up with the planned domestic borrowing, the federal government will have to issue a total of 2.8 trillion naira between July and December, which compared to maturing NT bills of 1.6 trillion naira and non-bank corporates estimates of OMO maturity between July and October of 1.2 trillion naira, it suggests excess liquidity of 680 billion naira. With PFAs, pension fund administrators, and individuals largely dominating the treasury bills and bond auctions, Nova sees the liquidity pressure further gravitating the NTB and bond stop rates lower from current levels of 2.5% and 10.4% on average, respectively. In all, Nova expects the Central Bank of Nigeria to continue to pressure banks to drive OMO stop rates modestly lower, with 1 year stop rate likely to fall lower within the range of 6.5% to 7.5%. Bond rates could fall at the next auction due to demand pressure to 10%, with a gradual convergence to almost single-digit rates, while the NTB 1 year stop rate could gravitate between 2% to 3%. And those are insights from Nova Merchant Bank Research Team. Let's get on to World Bank. There have been some interesting write-ups on the global economy as we navigate this period. In its recent write-up, it brings the motivation that the COVID-19 pandemic has plunged the global economy into its deepest recession since the Second World War. Per capita incomes are expected to decline in about 90% of countries in 2020. The largest fraction is recorded in economic history, and many millions will be tipped into poverty. That's what the World Bank current updates brings. The pandemic is also likely to leave lasting scars through multiple channels, including lower investment, erosion of human capital because of unemployment, and loss of schooling, and a possible retreat from global trade and supply linkages. These effects may lower productivity and limit the ability of economies to generate growth of real incomes in the long term. The likely adverse impact of the pandemic on productivity will be a worrisome outcome, as growth of labor productivity is the main source of lasting per capita income growth, which in turn is the primary driver of poverty reduction. Most cross-country differences in per capita incomes have been attributed to differences in labor productivity, whereas the one-fourth of the emerging markets and developing economies with the fastest labor productivity growth during 1981 to 2015 reduced their extreme poverty rates by an average of more than 1% point per year. Poverty rates rose in the emerging markets and developing economies with labor productivity growth in the lowest quartile. The pandemic struck the global economy after a decade that witnessed a broad-based decline in productivity growth. The productivity slowdown prior to the pandemic affected around 70% of our pandemic sparks an intense debate on how it will evolve in the future. Some innovations that have held the promise of considerable productivity gains, including digital technology and automation of production, are there. And in terms of the processes, they seem to have been disappointing in this regard. Meanwhile, EMDs experienced the steepest, longest, and most synchronized productivity slowdown over recent decades. In these economies, the accelerating productivity growth has put at risk hard-won gains in terms of catch-up with advanced economies achieved prior to the 2007-2009 global financial crisis. Labor productivity gaps with advanced economies remain substantial, with workers in the average EMDE producing less than 1/5 of the output of those in advanced economies. Against this backdrop, the book developed by the World Bank presents the first comprehensive study of the evolution and drivers of productivity, growth, and policy options to rekindle it. It makes several contributions to a large literature, which is nice to read. And still on the World Bank, stepping up its funding amidst the pandemic, it states that as people in developing countries around the world face multiple crises, including the COVID-19 pandemic, the World Bank Group worked to respond quickly with technical and policy advice and sealed up financing targeted to the poor and towards improving development outcomes. The World Bank Group supports rapid adjusted to help countries fight the pandemic by focusing on 4 priorities: saving lives threatened by the pandemic, protecting the poor and vulnerable, securing the foundations of the economy to shorten the time to recovery, and strengthening policies and institutions for resilience based on transparent and sustainable debt and investments. To support these emergency programs, World Bank Group financing was significantly scaled up, reaching $74 billion in commitments. Financing deployed together with technical and policy advice and analytical support is helping countries address health and economic impact of the pandemic, maintaining countries' private sector, aiding nations with food security due to locust swarms in Africa and the Middle East, and combating widening inequality among other key priorities. As developing countries face an unprecedented health, social, and economic crisis that is jeopardizing decades of development progress, we have been working intensely on fast, broad actions to limit the harm and help countries prepare for recovery so they can rebuild better and stronger than before. That is the statement of the World Bank Group President, Mr. David Malpass. Speaking further, he says, we've been focused on helping countries overcome the pandemic with programs that reinforce healthcare schemes and protect the poorest households, maintain the foundations of the economy, fight inequality, and ensure a resilient and sustainable recovery. Over the fiscal year, which ended on June 30th, 2020, the World Bank works to further realign its delivery model for efficient coordination of work across its regions and global practices. The bank's new operational model, which came into effect on July 1st, 2020, places country-driven development at the center of the delivery model, while strengthening thought leadership on development issues of critical importance to sustainable growth and poverty alleviation. In addition, the full year 2020, the Bank Group of World Bank worked with the International Monetary Fund to call on official bilateral creditors to grant debt relief to the world's poorest countries, those eligible for the International Development Association financing IDA. The G20 agreed on a coordinated approach, and private creditors were also called on to contribute to the initiative. The Debt Service Suspension Initiative, DSSI, which came into effect on May 1st, 2020, frees up resources for the poorest countries to respond to the COVID-19 pandemic and encourages debt transparency and sustainability. According to Mr. David Malpass, President of World Bank, even before the COVID-19 crisis hit, we were calling for a greater attention to the debt issue in poor countries, and the DSSI paves the way for long overdue action to increase debt and investment transparency and sustainability. We were able to contribute to a significant improvement in debt transparency over the fiscal year with the G20 endorsements and the launch of a website showing the country composition of projected annual debt service payments for all 73 countries eligible for relief under the initiative. Transparency of all governments, financial commitments, and investments is a key step in creating an attractive investment climate and could make substantial progress this year to deliver better outcomes for people in developing countries, he said. Support to middle-income countries from the International Bank for Reconstruction and Development, IBRD, rose to $28.5 billion in full year 2020, up from $23.2 billion in the previous fiscal year. Loans and grants to the world's poorest countries from the IDA were $30.4 billion during full year 2020. The 19th replenishment of the IDA in December 2019 secured an $82 billion financing package for the 74 poorest countries in the world to be deployed over a 3-year period. The boards of IBRD, IFC, the International Finance Corporation, and the IDA, which are rated AA and AAA, fund these organizations' operations, including programs that promote inclusive growth and policy reforms to create more opportunity for people. IBRD issued $75 billion in full year 2020, IFC $11 billion, and IDA $5 billion. Now we move on to FBN Quest Research as it looks at Nigeria's oil and gas sector. You all know that the oil and gas sector is among those exposed and facing challenges in this period. Beginning with the potential renaissance for the downstream sector, FBN Quest is saying that the downstream oil and gas business is typically a low-margin one. However, other factors, mainly constraining policies, have led to historically low investments in the sector over the last decade. From the view of FBN Quest, the fortunes of the sector could change with the growing possibility of full pricing deregulation. It believes the reintroduction of a market-friendly pricing template for gasoline in March and the central bank's current attempt at unifying foreign exchange rates increase the prospect of the end of mandated gasoline proceedings and price ceilings. In terms of key policy decisions expected in third quarter of 2020, the newly adopted pricing template takes into consideration several factors such as the petroleum product costs and the foreign currency conversion rate at which all marketing companies import petroleum products. And FBN Quest expects the recent adjustment of the Naira official FX rate from 306 Naira to $1 to 280 Naira to $1 to test the durability of this template within this quarter. Assuming all other inputs remain constant on the most recently published PPPRA gasoline pricing template, an adjustment of the FX rate assumption to current levels raises ex-depot prices by approximately 20%. In terms of food regulation, this could spark medium-term investment boom. According to FBN Quest, competition within major marketers is growing with new ownership and management. Adova, formerly Forte Oil, not covered, and 11 PLC, which is former Mobile Oil PLC, not also covered in this. They are leading the charge. In the first quarter, Adova and 11 PLC became the leading distributors of gasoline with 23.8% and aviation turbine kerosene 27.2% respectively. Positions previously occupied by Total Nigeria in the event that the federal government decides to continue with the new pricing template effectively deregulating the sector. FBN Quest sees competition intensifying over the long term. Under this scenario, reach and distribution will be a key competitive advantage for the players in the industry. As such, the near-term sector headwinds weighing on the outlook. In the near term, FBN Quest expects the industry to take a hit from the measures adopted to stem the spread of the COVID-19 pandemic. The implementation of a total lockdown, followed by a partial economic reopening in key states, Lagos, Ogun, and Federal Capital Territory, should result in declining gasoline consumption for second quarter 2020. FBN Quest estimates a gasoline consumption contraction of between 40 to 45% in second quarter 2020, even though product importation grew by 8% year-on-year to 5.3 billion liters in the prior quarter. There is experience of subdued earnings in 2020. For Total, FBN Quest forecasts sales and EPS declines of -6% and -70% respectively in 2020. FBN Quest projections are driven by both relatively lower petroleum product demand and a double-digit decline in product pricing year-to-date. Its forecast assumes a mild rebound in COVID-19 cases and that economic activities are allowed to continue under such circumstances. FBN Quest says there's a price target of 117 naira for Total and a neutral rating for the stock. At current levels, this implies a potential upside of 20%. That's from the FBN Quest analysis on the oil and gas sector and what is going to play out and what stakeholders should look at. Now, yesterday was a very significant day in Nigeria's history as it continues to seek to diversify its revenue from dependence on crude oil. President Muhammadu Buhari, at the launch of the Presidential Artisanal Gold Mining Development Initiative, made some very important remarks at the event. He first used the occasion to thank all the stakeholders for their painstaking efforts in developing a program that will enable improved sourcing and refining of high-quality gold bars derived from mine fields in Nigeria. He said that the PAGMI initiative, which was launched in 2019, is well-timed when one considers the impact of COVID-19 on the global economy and indeed on the Nigerian economy. The impact of COVID-19 and the containment measures designed to slow the spread of the virus has led to a slowdown in growth, which is projected to decline into negative territory for the first time since the Great Depression. It has also led to a 40% drop in crude oil prices. Speaking further, he said in Nigeria, the drop in crude oil prices has had a significant impact on government revenue and as well on the foreign exchange earnings. In responding to this challenge, the President said it was therefore paramount that there's a strengthening of efforts and implementing policies and programs that will enable greater diversification of the Nigerian economy. He said enabling investments in the soil mineral sector is a key part of the government's economic diversification program, given the current estimated gold reserves of over 200 million ounces, most of which have not been exploited, developing sustainable programs that will catalyze increased investment in the extraction and refining of gold sourced from mines in Nigeria, which is vital. Speaking further, he said this initiative will also support job creation efforts in the country, particularly for artisanal miners, by providing them with a guaranteed offtake by the Central Bank of Nigeria. He said efforts are being made to support artisanal miners in improving the standard of the gold that will be sold to the Central Bank in order to ensure that they meet international benchmarks. In addition, the PACMI initiative, according to President Muhammadu Buhari, will enable the deployment of financing schemes that will help miners improve on the quality of their mining. Those are key remarks, excerpts of the remarks from President Muhammadu Buhari. Also, just to inform you that the Federal Executive Council this week approved the medium-term economic framework for 2021 to 2023. The MTEF will help to drive the fiscal policy direction and also align the budgeting plans that will cover the period in focus. This is going to be part of the government's effort in stabilizing the economy. It also covers the fiscal strategy paper with a projection of a 12.66 trillion naira budget for each of the 3 fiscal years. And also, the International Monetary Fund, in its recent update, has said that Nigeria faces a 36.5% debt to GDP ratio margin for the year 2020. This is an analysis from the Global Multilateral Financial Institution that is seeing developments in the country. Ms. Jasmine Rahman, who is the IMF senior representative for Nigeria, made this projection ratio when in an interaction on the economy. He said this year, that will be up the 29% in terms of this from 2019. The senior financial sector specialist of World Bank, Mr. Ahmed Rostom, also said that about 42% of staff working in the Nigerian hospitality and service industry before March have now lost their jobs due to the effects of the COVID-19 pandemic on the economy. The IMF chief described the spike in government borrowing in the short term as worrisome and one that should be closely monitored. She, however, said as long as debt to GDP ratio stays below 45%, it will still be sustainable. Interesting times to look at what's going to happen in the Nigerian economy and developments around the political and additionally investment space. And it's been an interesting week of coverage of activities in the Nigerian economy and politics space. Just to ramp up with the fact that yes, a lot of Nigerians are being held up currently now as they're trying to go out of Lagos, Nigeria's economic capital, and even those are trying to come in. It's part of what happened over the night, an accident involving tankers around the Kara Bridge, where we're having some construction activities to expand the Lagos-Ibadan Expressway. We really identify with all these people because it's a challenging time being on the road for over 2-3 hours, and we hope that the efforts at quick response to emergency and the efforts at expanding that road will be ramped up and concluded so that we can reduce man hours on the road, which is really a big challenge in the axis of Lagos and going out of the city. Also, this brings to the fore again, leveraging our rail transportation networks to reduce the impact of road transport in the city. And that will be a wrap for the Economy and Politics show for this week. Please send your comments and views to news@proshng.com. Join our website, www.proshng.com, to watch our videos with our news reports and analysis. Till we come your way again, in whatever political economic debate and conversation you engage, make sure it is constructive and productive. Thank you for watching. Have a nice time and stay safe.